What is the capital asset pricing model all about? What we call CAPM. If you're doing the ICANN examinations or taking the ACCA examinations, if you're preparing for these professional examinations in accounting and finance, maybe, you're likely to meet CAPM, that's a capital asset pricing model. But apart from passing examinations, because I always explain to students that knowledge is not all about displaying capacity in the examination. It is more about putting them to use in real life. So what is the CAPM? What is it all about? What do you use it for? Let's begin. So, as an investor, investors invest and they expect returns. Usually we say the higher the risk, the higher the returns. What are investors paid for? I mean, the returns investors get. Is it because, we all know it's because of the risk they take, but what kind of risk? Is it the risk that is specific to their stocks, the stocks that they have bought, they have invested in? Or is it because of the market risk, the risk of the market? This is very, very important. So this is what CAPM demystifies. CAPM answers these questions by separating risk into two. We have what we call the systematic risk, and we have the unsystematic risk. Together, the systematic risk and the unsystematic risk is what gives us what we call the total risk. Now, I want us to explain this risk one after the other. When we understand what makes up the total risk, that's the systematic and non-systematic risk, we'll be able to explain or understand the CAPM better. Okay, so firstly, let's understand what is unsystematic risk. I want to begin from unsystematic risk. Now, this risk is firm specific, is company specific. This is the risk that we call diversifiable risk. It is not the risk that affects the entire market or the entire economy. It is the risk that affects a particular firm. It is specific to the firm. What are the examples? For example, you talk about bad management. A particular firm may have bad management. Their management is bad. So when you invest in that firm, in the asset that is sold by that firm, their bad management can affect you. So that is a firm-specific risk that you are taking. There's bad management. Another example is strikes, labor strikes. Another example could be litigations. All these are examples of firm-specific risk. So this risk can be diversified away. How do you do that? When you take an investment, you have various investments put in your basket of investment. Now, this basket of investment is what we call a portfolio. When you say portfolio of investment, you have, let me explain it very well. If you are to invest in beans storage, for instance, and then at the end of the year, all the beans were affected by weevils, you are bound to make a loss. If you have 10 million naira and you invested the whole of your 10 million naira in this beans storage, and for that year, all the beans that were stored were affected by weevils, you will lose your investment, the whole of your 10 million naira. But if you invest only 1 million naira in bean storage, you invest another 5 million naira in oil and gas, and you invest the remaining 4 million naira in another investment, let's say clothing, in a clothing company. At the end of the day, if beans is affected by weevils, you will lose only 1 million naira. Because of what? Because you've been able to diversify your investment. So this is the assumption of CAPM. CAPM assumes that every investor in the market is knowledgeable about diversification. And so when you diversify your investment, you are able to eliminate the risk that exists in firm-specific areas. The risk that are firm-specific, company-specific, not general risk. You are able to diversify away this risk. You are able to eliminate this risk by diversification. So we also call the unsystematic risk diversifiable risk, avoidable risk. You can avoid this risk by doing what? By diversification. Good. All right. Now let's move ahead and look at the other type of risk. The other type of risk is what we call the systematic risk. Let's understand what it means. Systematic risk, on the other hand, refers to the risk that affects the entire market, the entire economy, and they are driven by macroeconomic factors. So they are not firm specific, they are not company specific, okay? They are not specific to a particular area or a particular asset. No, but they are general, okay? They are caused by external factors. You do not have control as an investor over them. There's nothing you can do about them. You cannot diversify, eliminate them by diversification. They are always there because they are caused by macroeconomic factors. Examples are recession, pandemics, inflation, wars, interest rate changes. So you can see that this affects the entire market, not a particular firm. Now, this risk cannot be eliminated through diversification of investment, unlike the unsystematic risk. So this is the risk that investors essentially get rewarded for. If you take this risk, that is the one that gives you returns. For unsystematic risk, it can be diversified. It can be eliminated by diversification. So the risk that investors get paid returns for is the systematic risk. Having understood this, let's go ahead and see. Now, there is something we call beta. Beta represents, it is what we use to measure this systematic risk. So we say beta is the volatility. It measures the volatility. You understand? Volatility, that's to say it can change without warning. It is unpredictable. So that risk that is volatile is measured by the beta. So when beta is exactly 1, it means that the stock, that is the risk that affects the stock, is exactly in sync with that of the market. In other words, if the risk of the market grows by 10, that of the stock will also grow by 10. If it comes down by 1, it means that of the market will also come back. That of the stock will also come back by 1. So they are in sync. That is when your beta figure is exactly 1. That is what it means. On the other hand, if your beta is greater than 1, it means there is a high risk. What this means is that the stock is more volatile than the market, so there's a high risk. Then if beta is less than 1, it means the stock is less volatile. That means less risk. It means it's less volatile compared to the market. Okay? Now, when it is 0, when beta is 0, that is what we call risk-free, like treasury bills. It has no risk at all. The government will always pay you. You are sure of getting your returns. It is 0 risk. So when that happens, we say the stock is risk-free. When beta is 0, it is risk-free. So it means the stock is uncorrelated with the market. It does not matter. Whatever happens to the market, you will get your returns. Then when beta is less than 0, that is negative, we say the stock is moving in opposite direction to the market. And that is very, very rare. All right. So having known all of this, what systematic risk is, what unsystematic risk is, what beta is, and what the result of beta can be interpreted to be, we are now going to look at the formula of the capital asset pricing model. Now, this is the formula displayed. We say expected rate of return, that is the cost of equity here. The expected rate of return is equal to what? RF, that is risk-free, plus the beta, which represents the volatility of the market. Okay? And then multiply by RM, which is the return of the market. And of course, you have our RF. So now, I want us to understand what these are. These are just symbols. We're going to substitute numbers, okay, into all of these symbols. So having understood that, we say RF means risk-free rate. RM is a market return. RM minus RF for examination purpose. It is very important to know what this means. They might ask you, what is the meaning of RM minus RF? It means market risk premium. This means market risk premium. That is what it means. You see this? This is very important. It means market risk premium. And then this is our beta. So it measures systematic risk, as I explained before. Good. Now, let's look at an example. Using the CAPM, calculate the expected return. Is what they say we should do. Calculate the expected return of a security given the following information. So we are told that our risk-free rate of return is 3. Expected market return, RM, is 9. Beta is 1.2. And then we're told to show all necessary workings. So let's quickly do that. Now what this means quickly is, we say expected return is equal to RF, which is what? RF here is 3 plus our beta. Beta is what? 1.2. 1.2 multiplied by what? Our market risk premium is what? So you have the RM. RM is 9%. 9%. So you know this is percent. And of course, this is percent. Good. So we'll say this minus 3%. So now this gives us 3 plus, let's do this brackets using board mass. You know you have to finish the bracket first. 9 minus 3 will give us 6. We'll have 6. So we have 1.2 multiplied by 6%. So 1.2 minus 6, this will give us 3 plus 1.2 multiplied by 6. So you say 1.2 times 6. That will give us 7.2. 7.2. Which is equal to, this is 10.2. So this is our answer. So our answer is 10.2. So we have shown all the workings. All right, after that, what does this result mean? What does it mean? Now, what it means is that we have 10.2. That is the expected return. So investors are expecting to be paid a return of 10.2. Okay, by our calculation. Now, if you are told that the expected return is even more than 10.2, it means it is better. It means it is undervalued. Okay? It means it is undervalued. Good. So that is a good one. On the other hand, if it is less than 10.2, it means it is not a good one. You should avoid it. So basically, this is the interpretation of the result. So for taking the risk, for taking that risk, which is the systematic risk, investors expect to be paid a return of how much? 10.2. For taking that risk, this is the return that you expect as an investor. Also, this is also a measure of the cost of equity. In case you have anything to do like valuation of stock, you need the percentage to calculate your cost of equity. By using the CAPM, you know that the cost of equity is what? 10.2. So this is the CAPM, that's a capital asset pricing model, and this is what we use it for. So if you have enjoyed this class, I urge you to subscribe to the Accounting and Finance Coach channel on YouTube and follow us on all our social media handles. We'll bring you another interesting topic, either in accounting or in finance or in taxation. Continue to follow us, subscribe, like, share with someone so that we can increase financial literacy in our society. I remain Echela Okori, your accounting and finance coach. Bye for now.